and welcome to this masterclass discussion on financial crime compliance. My name is Brian Caplen, I'm editor of The Banker. I'm here with Tom Scampion, Global Risk Analytics Leader with Deloitte, and with Luc Meurant, who is Head of Banking, Markets and Compliance Services at Swift. Tom, if I could come to you first. So what are the key trends in this whole area of financial crime compliance?
Well, Brian, I think there's two. I think one is around increased regulatory pressure. Clearly, sanctions at the moment are very much in the news, and when you have things like sanctions as part of people's foreign policy objectives, making sure they observe consistently is very important. Of course, regulators are increasingly moving to the concept of if you could know, then you should know, which creates a lot of expectationary pressure on the industry. And then finally, the idea of some of the recent public cases about personal liability is creating a sense of tension within the community, and therefore that regulatory pressure is clearly increasing. And at the same time, we live in a very complicated environment. Banks are complex. They have multiple lines of business in multiple countries with local standards that need to be observed, and demonstrating control over that complicated picture is a challenge. So I think the two trends I'd pick out are the increasing regulatory pressure along with the inevitable complexity of running a global bank.
Look, looking at it from a Swift point of view, is that the same way you see the world developing, or a slightly different take on it?
We hear the same things. I'd like to add two more trends we can see. One is that increasingly we see a lack of clarity in terms of what is expected from those banks. I'll give you one example. Each bank is expected to screen against sanction list. But when do you stop? Are you supposed to screen the exact match of the names, or do you need to allow for some permutation of the names? That's what we call the fuzzy logic. When is good enough? So there's a lack of clarity, for instance, in that case. And the second one, which we see loud and clear, is the desire for banks to work together. Collaboration those days is key. Dramatic change versus 2 years ago. Nobody wins in terms of compliance, so there is big appetite for banks to work together. It is non-competitive, so collaboration is key.
Okay, Tom, what about this idea you mentioned where if you could know, you should know? Okay, because that's a big shift, and it's also very challenging for a bank, isn't it? Because you're talking about this huge organisation with lots of parts all around the world. It's more or less impossible for a bank to know everything that's going on everywhere, isn't it?
Well, it's certainly a challenge. I mean, the well-publicised investigations which have come to fruition in the last few years have had various regulators in law enforcement being able to spend a number of years poring over the way in which a bank has operated, and inevitably things will be identified that are not what the bank would have wanted to have happened. And then translating that into a business as usual environment is where the challenge comes. How can we be confident that in our BAU environment we're doing what, with the benefit of hindsight, and as a result of some of these investigations, I would have wanted to see happen? And that's where I think, Brian, the challenge predominantly lies.
Okay, and look, and you mentioned that the regulations aren't absolutely crystal clear on what's expected. I mean, how can banks respond to that kind of situation?
Well, at the end of the day, it's a risk appetite kind of decision. So basically, banks will define parameters that meet the risk expectations, and the lack of clarity will translate in some risk being taken by banks. And of course, they will try and minimize that, but it's going to be every single bank's individual decision.
Okay. Gentlemen, let's come back and talk about the sort of detail on the risk assessment and control in just a few minutes.